Hello, everybody. Welcome back to another episode of Cup of Joe. I am Joe Gallimore, Director of Investment Research with Argent Bridge Advisors. Well, the 2 weeks ending September 24th were very interesting. The market moved a lot, only to end up in pretty much the same spot where they started. For instance, the S&P 500, the large cap US index, it only moved 0.04% in that 2 week time. But in the middle of that 2 weeks, it had a single down day of over 2%. So lots of action only to come right back to the start. So two comments about this market we saw over the past 2 weeks. First, there's a lot of churn going on beneath the surface. Many stocks are experiencing volatility since the market peaked back in May, and that's across all market caps, large, mid, and small size companies. This sort of churn beneath the surface could be a very good thing for actively managed strategies. The second, what caused this down and up, and is it worrisome? Well, the 2% drop in one day, that was seemingly caused by worries that a troubled real estate development company over in China is going to potentially default on this debt. And people were worried, well, is this going to have ripple effects into the Chinese economy and then seep into the global markets because China is the second largest economy in the world? Well, this worry was very short lived because the index rebounded basically in the next 2 days and recovered that 2% and then continued to rise through the end of the week. Well, that movement was driven by comments from the Fed, which we've been hearing about all year. The Fed met on Thursday and came out with comments following that, where they admitted that they see economic growth is slowing and thus they don't intend to raise interest rates anytime soon. Well, the stock market like this. So it got back to where it started that 2 week span, which is just under 20% for the year. So there's a lot of market forces at work right now. Much of it is just systemic turnover in the stock market, which is pretty much ever present. And then some of it is influence from these external events, such as headlines, global headlines, and policy decisions for many months off in the future. Um, but what we're seeing is this is the reality of being invested, and we hope this kind of market truly turns out to be a stock pickers market because that favors actively managed strategies, which we own for all our clients. So that is it for this latest installment of Cup of Joe. If you have any questions, please reach out to me or anyone on the team. Have a wonderful day.